So in today's video, I'll be giving my review and analysis of the Ntflx stock and seeing whether it'd be a good fit for you guys' investment portfolios. But before we get into it, guys, if you're new here, definitely consider subscribing. I'm on a goal to get to 2,000 subs. Also, if you like the video at the end, definitely consider giving it a thumbs up. It really does help boost this channel out and gets it out to a wider audience. And also leave me a comment as well with your thoughts. So straight into it, guys. Ntflx, everybody's heard of Ntflx. It's a subscription streaming entertainment service which offers a variety of TV series, documentaries, feature films across many different genres and languages. The company also provides the members' ability to receive streaming content through a host of internet-connected screens such as TVs, digital video players such as tablets, and obviously phones as well. They also provide DVDs by email and membership service. The company has approximately 167 million paid members across 190 countries. Ntflx was founded in 1997 and the headquarters is currently in Los Gatos, California. A brief look at Ntflx's timeline. Obviously, as I said, founded back in 1997, and as you can see, the growth of Ntflix has just been ridiculous over the last 23 years. From launching the website back in 1998 to hitting the milestone of more than 5 million subscribers in 2005. And the launch of the streaming service, which at the time in 2007 still many people, including myself, was probably still watching DVDs. So it just shows how ahead of the game Ntflix really were. Going worldwide in 2016 to now surpassing over 150 million subscribers, and I think they're more towards 180 million mark now. So Ntflix really company that's grown a lot over the last 20 years. The main base source of revenue, which is the subscription services for the streaming. So they have a basic plan, standard and premium. You can see the prices obviously differ. Basically, the main differences are between basic and standard. You can watch on more than one device, and you can also watch in a resolution of 1080p. And then the premium, it has 4K HDR resolution and the same as everything else. So depending on how much you actually do watch Ntflix, it depends on how much you want to be willing to pay. So as you can see, as of September the 30th, 2020, on the earnings and revenue history, they currently have 23.8 million in revenue, keeping 2.8 billion in that in earnings with an 11% profit margin. Basically, earnings is what they keep after they've paid everything off, such as any debts or wages for employees, and just basically what they're left over with at the end. And many companies distribute earnings as dividends out to shareholders, but Ntflix don't do that. I would see it as more of a growth company. The earnings have grown significantly in the past year by 53.6% over the past 5 years, So these 3 points are earnings trend, accelerated growth, and earnings versus industry all exceed what they're expected. Again, earnings versus saving rate, earnings versus market, high growth earnings, and revenue versus the market. The only downside is they get the growth of the revenue is forecast to grow slower than the 20% per year, but still, it's not too bad. And the earnings are expected to grow significantly, so they'll be keeping more of the revenue. Now, which is a similar graph to what we've just looked at, but this is the forecast revenue growth, earnings and revenue growth forecast. That was a tricky thing to say. But their forecast in 4 years' time, take this with a pinch of salt, this is just what analysts say. So you can see how many analysts have been looking at these different sectors. So they forecast to keep 44 billion in revenue and keeping in almost 10 billion in earnings. So you can see the growth is, especially if the revenue is to grow absolutely massively. And I do think a company like Ntflix are going to continue to grow each year. A really good company, and many people, I don't think it's going anywhere yet. Obviously, Disney Plus have launched their streaming service, which obviously could be seen to a threat to Ntflix, but at the moment Ntflix are really much still top dog in the streaming service. A quick look at now the financial position analysis, so the assets versus the liabilities in the company. If you're not sure what they are, I've said this in previous videos, but if this is your first video, I'll say it again. Assets are basically something that brings a company income, and liabilities is what takes it away. So on both the short term and long term, the assets do outweigh the liabilities, which is a really good sign. Ntflix's debt to equity ratio is considered high, a debt of 16.47 billion with an equity of 10.33 billion with 153% debt to equity ratio. So obviously the fact that they use debt to pay for a lot of things, Ntflix, so I'm not surprised at that. Netflix debt to equity ratio has increased from 110% to 153%, so the debt has been increasing. One good thing is the interest payments on debt are well covered by the earnings before interest tax. But if you're not sure what debt to equity ratio is, it measures how much a company is financing its operations, which is basically is how it works, like paying employees, etc., and just how they run the company day by day, basically. But basically, yeah. So sorry, going off track there. Measures how much a company is financing its operations through debt versus wholly owned funds, which basically their own money. The higher the ratio, the more debt the company uses to fund the operations. So I still don't think the debt is a big issue. Netflix do bring a lot of money in, which is higher than what they do pay for what the debt is. So I wouldn't be too worried. Onto the valuation of the company now and returns in the stock market. So in the last year, Netflix have grown a massive 74%, which is higher than the entertainment industry, which sits at 49.7% and beats the US market hands down, who only returned 23.6%. I say only, that is still a good return in general. So it's exceeded the industry and the market also. Netflix are currently seen as overvalued on Simply Wall Street. They're trading at £512.66 at the moment, with a fair value to be said at $290. Simply Wall Street are getting this information with a fair value. They estimate what the stock price is worth today based on cash flow and what the company is expected to generate in the future. So they're saying that the company is really based too high. So that I take it again with a pinch of salt. This is all analysts' opinions, but they're probably not far wrong. Netflix is ridiculously high at the moment, but we'll just have to see how the revenue and earnings do increase over the coming years to see whether that would be a good price. So would I buy personally at this price? I'm not too sure. I'd have to probably dive into this a little bit more. And also Netflix, again, they're getting more subscribers each year, so I do think Netflix is a really good company to invest in. Again, do your own research, look at balance sheets and financial history, earnings, etc. Netflix don't currently pay a dividend and obviously seems more of a growth company, so I can't go into the dividend detail with you today. So yeah, that is pretty much it for the video today, guys. Let me know what you think of the video in the comments. Also, don't forget to like and subscribe as well. I'm going to leave you to it today, guys. Take care. Bye.